Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On this show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, franchising, and more. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. Salvatore Tirabassi is a seasoned CFO and also brings 15-year background as a partner in growth equity and venture capital funds. As a fractional CFO, he brings a comprehensive background in financial strategy, financial modeling, analytics, data science, and capital raising. Over the course of 20 years, he has developed world-class expertise in strategic forecasting and capital management, significantly enhancing the financial operations of the businesses he partners with. Listen, this guy's a tenured CFO. I love the fact that Sal has a background in private equity and venture capital, so he brings something to the table on that end as well. Welcome to DealQuest Podcast.
Thank you for having me. Great to be here.
So listen, I want to get into all of that, what you're doing now as a CFO, what your background in private equity and VC and how that, influences obviously what you do now. And I know you work with companies that are getting funding and growing and exiting and acquiring and all that kind of good stuff. But before we get to any of that, I want to take you back to when you were a little kid, maybe 8, 10, 12 years old. What did you want to be? Because I'm pretty sure that an outsourced CFO wasn't it back then, but you tell me.
No, I was, I played a lot of sports. I probably when I was 11 or when I was 12, I probably wanted to be a professional basketball player.
Sure.
I guess it seemed like a cool thing to do. I was I went to a high school and played basketball in New York City. So it was very competitive with a lot of, awesome players. So there was always like the dream on everybody's mind.
Yeah, I know. I sort of had that dream as well. And, in my Brooklyn high school, it became very, very clear that the only sport that I could actually even make the team, and I actually let it in, was bowling. I was a good basketball player, but at 5'8", that was the limit of my ability to be a respected schoolyard ball player.
Well, I'm 6'1", and my body type is really more probably suited for a hockey player than it is for a basketball player. So
I love it. One other question looking back, what was your first deal of any type? Could it be early in your career? Maybe there's something even younger, but anything you would consider a deal?
it was anything that would have been considered a deal. Yeah, it probably would have been like when I came into the venture capital industry.
Sure.
Out of business school, because before that I was in consulting, and I sold some projects probably, but nothing that I can remember. They weren't really like
most sales. Yeah.
Yeah. So, but the first big deal and really interesting one that we did was and this may be, an interesting tangent to go into for the audience, but because it's related to like the AI bubble. But when I graduated from business school, I got out and started working in like August of 1999.
Okay.
And by March of 2000, everything had blown up. And I worked for a relatively new fund, which had raised 2 funds in a row, kind of back to back in like a very short period of time through 1999. So they had a decent amount of capital and they were deploying it, and they had a lot of exposure to this very tippy market. But they were willing to continue backing their investments. And when a lot of the investors ran for the hills, they were willing to see what was left and kind of double down into certain things. So the first deal that I did really there was this company called Gomez, which was, believe it or not, it was like a SaaS company before people knew
Right.
before the term was
The
used.
term wasn't even used back then. Yeah, yeah.
Yeah, it was not used back then. We always just referred to it as recurring revenue software or services or something like that.
Yeah, yeah.
What Gomez did was, it's a very cool business model. They had these servers in data centers around the world, basically, and their clients would use the Gomez network to measure what the client's experience was going into their website,
Okay.
which at the time, a lot of this was really new, but it was like Amazon was one of their customers. And it was like, they wanted to know, like, when somebody's buying books, what's the latency? Is it something that's happening outside of our data center that's giving them a bad experience? Because they could only really see at the time, based on where the technology was, what was within their control area, which was everything inside the data center and back into their systems.
Yeah.
But if there were things, and the internet was still, I mean, it wasn't new at the time, but it wasn't what it is today.
Yeah, it was.
You could see, like, with this person,
only.
yeah, is this person taking 5 seconds to click through a shopping cart because of something that's on their side, or is it on our side? So anyway, so Gomez had this service, and they would charge a monthly annual fee, and all these companies were their clients. And that was like one of the companies we bought, and we ended up selling it for like, oh shoot, I think it got bought for like $350 million in like 2008 probably.
Wow.
So that would be like my first deal that was kind of like, an interesting one.
I love it.
And if you want to talk about the bubble, the AI bubble,
Yeah, yeah, yeah.
we can save that conversation, but I have some thoughts about that, because a lot of people ask me, like, hey, you were around for the internet bubble. How is this different?
Yeah, yeah, yeah. No, I definitely, let's make sure we go there. But, it's interesting because obviously I was around those times as well. And it's sort of making me reminisce and think about, like, we have, I'm sure, plenty of our listeners who were around, but plenty who actually didn't experience that, weren't around, or so weren't old enough to be in business. So younger listeners, and it's really amazing to think about. Yeah, because it was a real bubble. And like, the way they talk about AI now is the way they talked about .com, back then.
Sure.
Right. Obviously, there are a lot of differences. And yeah, I remember those times, and I remember how many companies, what froth there was, and how many companies. And then, yeah, it's funny. I'm thinking about this going to having Amazon as having these services, and having Amazon as a client, in terms of where like AWS ended up being, like later on,
Yeah, sure.
people don't understand how bad of a business that is for Amazon, right? The AWS.
They don't even think about buying that type of a service from anybody now. They just,
Right.
they've got probably 10 different ways that they could figure that out.
Yeah, that's amazing. So that was your first, basically it was business school, and you hopped into that world, huh?
Yeah. Yeah. It was like really kind of like the early stages of how venture capital and private equity were evolving into like an alternative kind of capital market.
Yep.
I don't think people would have described it that way back then, but that's certainly sort of what it's become.
Yeah, so actually that's a great, talk about a little more about that evolution, right? Because it's amazing, like, we're not talking about ancient history. I get it. You and I have been around for a minute, but when I talk about ancient history, but the evolution and this, like, things that people sort of take for granted now, and the way that VC and private equity deals are done, and sort of, the certain things that are consistent and accepted practice now and whatever, like, it wasn't as clear back then, right? In terms of the models, and in terms of even some of the terminology. Talk to me a little bit about your experience about that evolution. What was it like back then, and how's it evolved?
Yeah, I think back then there was definitely like the well-known names in Silicon Valley, because the venture industry had been around, since like the late 70s, and it kind of evolved. So now you're already like, let's just say 1980s, like a good starting point. By 2000, you're already 2 decades in. But it wasn't, the size of the funds was not what it is today. The amount of capital they were trying to deploy was different. The maturity level of companies was probably a little more mature. And also it wasn't like as tech oriented. There were other things that were potentially big opportunities. And then on the PE side, which at the time I wasn't as familiar with, I got more familiar with it as my career advanced. I mean, I think we're still like the early days of like in a lot of ways of there were the big sort of buyout shops that would do leveraged buyouts
Yeah.
and kind of corporate takeovers. And then in between, it was maybe a little bit more of like a barbell market, it was like big stuff and like little stuff. But then, really what happened over time was like all of the other tiers of capital structuring got filled in with more professional management and more organized fundraising. So you had, later stage venture, private equity market dropping down into like being more buyout, not as debt oriented, leverage. Then you started having like the BDC market came around and there was like professional alternative lenders to the banks. So all of that kind of like filled out over that time
Yeah.
frame. And then other things like sort of converged also kind of into that market. Like, for example, the asset-backed securitization market, which is like what Mike Milken did, and the packaging of different types of loans into a portfolio and selling them off. That was like another layer that kind of got introduced in. And certain companies that were not huge could actually access that market and then, get liquidity that way to build their businesses. So a lot happened over that time frame.
It really did, and I think you're right. Like that access to capital in various ways, in that in between space, and then you sort of development even on the M&A side, right? Of more, again, you used to have the big investment banking shops, and then you had like Main Street brokers, and that in between level on the M&A side, similarly filled in with more professional, investment banks coming down market, or and things like that. So yeah, it's been an interesting evolution. And then the other thing is for the audience, like a lot of stuff that we take, like now it's like, okay, you do a friends and family, maybe you do an angel round, then there's a series A, a series B, a series C, like, or you have, safe notes, Y Combinator, like a lot of that's like, a lot of the stuff that's accepted sort of practice or, the journey. I'm not saying the elements weren't around, but it wasn't, so sort of systemized and standardized,
Yeah. I mean,
as
even
as
like
now.
take things like safe notes, and founder friendly terms, that's relatively new. And as more founders became more experienced and were able to step back into the market, whether they were successful before or whether they weren't,
Right.
they became more sophisticated about how they wanted to structure their deals. There was because not all financings were, now I don't want to say founder friendly. Of course, that was probably not the case back in the day, but the founders had a better sense of deal terms that would, one, give them good economics, but also two, give them a little bit more freedom to be able to operate and run the business the way that they wanted to.
And then obviously as more players came in, there's more competition, which obviously helped that negotiating, value, position as well for of founders,
Yeah.
So yeah, no, it's it's been a fascinating evolution over time, and people who went around that may not realize how different it was, back in the day. I mean, yeah, I was involved with securitizations of loans, at that time that like the early mortgage-backed securities,
Sure.
before they got, when they first started doing it, and we did a $500 million shelf registration for the Dime Savings Bank back in the day, which was huge for that time. I mean, nowadays, $500 million, whatever, right? I mean, it was unprecedented, and it was, and even like, you talk about, how things have evolved. I mean, the banks who were securitizing those loans back then triggered the banks to actually get better on
More sophisticated.
yeah, more sophisticated, making sure they had all the T's crossed, I's dotted, and not missing endorsements or things like that, which you used to see. I mean, people now it might be surprised at what a mess, some of these loan files were back then until
Yeah.
the securitization market forced them to, really get their act together.
Yeah, and I think even on the data side of those types of assets where there's a lot of like, recurring payments and, trying to figure out what are your write-offs going to be, what are your prepaids going to be. In this day and age, it's relatively easy and straightforward to do. But, back then, they're with old technology and old systems, it's probably pretty painful.
Yeah, totally. All right. So tell us a little bit more about, your journey, right? So we have you in the VC world that mentioned that you later moved over to private equity. Just, move us along from, tell us a little bit more about your experience.
Yeah, so I mainly was always doing kind of growth equity deals in tech-enabled services, a lot of recurring revenue, a little bit of media. Then I moved over to the operating side and became a CFO. Basically, then merged everything that I had learned kind of as an investor and as a CFO into kind of like a method. Not kind of, but a methodology and a principles-based approach to the CFO function that is very geared toward helping founders and family owners get sort of the best of breed capabilities that you would get from private equity grade finance and be able to leverage it in their own businesses and to give it to them on a permanent part-time basis so they don't really have to think about having to hire the whole team. There is downtime in finance and there is overhead associated with finance. And our model is really to package everything, deliver it with like really good efficiency and technology and make it very cost effective for them. And we can, obviously make a good profit on our side, but it's less expensive than them putting a full-time team.
Sure.
So,
Yeah, so I definitely want to delve into that some more, a little as we go along, in terms of exactly what you do now, who your clients are. But before we go there, talk to me a little bit. I always love when I have people on who have been on quote unquote sort of both sides of the table, or been investor side, operator side, right? All that kind of stuff. And I'm always curious, like, so when you move, well, actually, so we didn't really talk about, like, so you moved into private equity as well, right? So you actually have the VC perspective, private equity perspective, which is sort of the investor side and different things, and then sort of an operator perspective. Was there anything that you sort of surprised about, or that you learned, or that like had a different view when you got to the other side, when of the table as an operator?
I think as an investor operating at the board level, depending on the interest level of the person and, how they perceive their business relationships, they may not have like a really good view of like what it's like to be inside the company on the day-to-day to make things happen. So I would say like the big thing for me was really to understand like effective leadership, real kind of trade-offs that need to be made sort of like month to month in a business, dealing with crazy stuff that can just kind of happen to the business, ranging from like some HR related matters to you have like a massive snowstorm and people can't get to the office and, planning ahead for that. Or COVID is a great example of like figuring out when to send people home permanently. So those types of decisions, you hear about them and you participate in the decision making to a certain degree. But when you're inside in the trenches, it's a lot different. So
Yeah. What do you think? You work with these. No problem. You work with a number of different types of companies now, right? Yeah. Are they mainly companies that are looking to be funded, or do you have clients that are not? Because the decision, one of the things, one of my sort of pet peeves is anything that is sort of like put out as standard wisdom that should apply to every company in the entrepreneurial space, right? Everybody's going to scale and grow. Everybody's going to raise capital. Everybody's going to whatever, right? And the truth is that the far majority of companies are never going to raise equity, right? Capital, and frankly, a lot of them shouldn't, right? And certain ones definitely should. So in terms of your first of all, your client base, so you're working with both, and then what is it that has it be appropriate for folks in terms of stage, in terms of industry, in terms of plans to want to raise capital, and then talk to us about obviously the different types of capital you can raise, and obviously private equity deals are very different than VC, and
yeah.
deals.
Yeah, so most of our clients have some aspiration to raise funding, but it's not the way you might think about it in a traditional venture capital sense. We pitch our services to venture-backed companies as well, and that's a totally different mindset, right? It's like, I've got some institutional capital in, or I want to get some, and then it's really about selling a story and a vision that's very huge and can be one of very few winners inside of a venture capital portfolio. But the bread and butter is family and founder-owned companies, and these are people with a lot of skin in the game. They have a lot of intuition about how their business works. They're not necessarily building some brave new world type of thing. We help them raise what I would call practical forms of capital. It could be my receivables turns are reliable but slow, and I need to raise some sort of debt facility that's going to accelerate my ability to tap into those receivables and reinvest it in the business. It could be I've got a partner who wants to get out of the business, and we need to find an equity partner to come in and sort of replace them. Or are we making enough money that I can get a term loan on the business, push all the proceeds to that partner, buy him out of the business? It could be
Let's take a break from the show for a minute so I can tell you about an incredible resource my team and I have put together for you. Secrets of Deal-Driven Growth, Creative Ways to Grow Your Business Even in Challenging Times, is a powerful ebook that helps you take DealQuest podcast episodes and apply them to your own life and business. This is the ideal tool for anyone looking for creative ways to grow as deal makers, and you can get yours now. It's as easy as heading to coreycupfer.com/workbook and downloading your copy. While you're there, you can also consider joining our dynamic deal-driven community of founders, experts, small business owners, and entrepreneurs. Now back to the show.
I need just a larger line of credit of some kind. I need to go from $500,000 line of credit to $1 million line of credit. Help me figure that out. SBA loans are very common topics.
Yeah.
So it tends to skew a little bit more on the debt side, except when there's like a partner buyout or something like that. Then there's like the thought of selling the business, right? So I would say most clients are thinking like they want to build value and generate a lot of cash flow and then at some point sell it. The capital requirements are always around, like, if they're not trying to solve some cash constraint or buying somebody out, then it's about investing in the business. Like, I want to get these receivables coming in quicker with a line of credit because I want to spend more on customer acquisition or, that kind of stuff. So those are the types of things that we see. And we maintain a database of investors for, every type of financial product that could potentially work for our clients so that we know who to go to. And we also leverage not so much bankers. They're more, particularly on the debt side, they're more well-placed gatekeepers who have a lot of lender relationships, and they have a real good understanding of like small and mid-sized businesses, like what types of credit do they actually need to have access to. Those are good relationships and gatekeepers because you could have quick conversations with them, size up what you're talking to them about, and then they, usually have like a handful of ideas for you.
So let's talk about the debt side of things, right? Because, on the one hand, various types of debt financing, and you gave a great example, right? Where you want to finance receivables to get cash in more to increase your customer acquisition, rates, and that kind of stuff. But obviously there are companies that run into trouble taking on debt. What is and I know this is obviously very broad, but like that analysis of when it makes sense for a company to take on certain types of debt. And, like the classic conversation is, you shouldn't be constantly taking on debt just to finance operations. Then you got a business model problem. But obviously if you can take on debt for specific purposes that help you grow. So, that's the wisdom at a very high level. But yeah. Obviously, you help folks make these decisions. Should we take on debt? What are we going to use it for? What type of debt's best? Like, what goes into that analysis for your clients?
Really, if it's going to grow the business, what we really want to try to understand are the unit economics of what they're going to invest in.
Yeah.
So if they get let's just say for round numbers sake, $1 million of additional liquidity, they want to invest that to grow the revenue. What we help them frame out is, for every dollar that you invest in customer acquisition, how long does it take to get the dollar plus the interest back? Once you've gotten it back, what's the profit level that you're generating on that? And that helps kind of frame out just the straight up debt to profitability analysis.
Yep.
Then after that, we go a little bit deeper and we really try to model it into the forecast so that we can show how the revenue and the profits that are coming in are going to support that debt, but also drop more cash flow. And it's always a question of like, you're going to have a dip in the cash flow until you start, really growing, the classic J curve.
Sure.
And you want to basically see how far down does that go, and do you have the liquidity to support yourself during that dip? And we want to just size that up, right? Because you can't you can't really make the decision without it. And, there's different ways to skin the cat. It doesn't need to be like, a massive spreadsheet analysis. Although generally when we get involved, if we're at the stage where we've built you a forecast, we're building you a forecast that has like an extreme level of precision on drivers. And we can tell you like, if this moves 3%, this is going to happen. If these two things move by 3%, this is going to happen. But if you don't have that level of sophistication, there's always like a quicker way to do it. But once we have that done, then we have things we can actually talk about, right?
Right.
And make decisions on.
Yeah, and I mean, listen, for me, it's what you do is so crucial because, I mean, listen, as companies become more mature, they definitely understand some of these impacts, smaller companies. But I'm surprised sometimes at how much companies grow without really understanding their numbers and having, and not just as a static report, right? But as a real significant part of business strategy, decision.
Yeah. Yeah.
And
I mean, we see it all the time.
yeah, yeah.
The gut instinct and the intuition that they have about their business, works. But at a certain point, they start to realize there's certain things that they don't know and haven't really, or just starting to think about. And wouldn't it be nice if I knew what was behind that curtain? I would be able to do so much more. And that's, it's either that type of mindset that gets us a phone call, or it's, liquidity issues.
Yeah.
And that's where like the intuition was good enough to a certain point, and now it's not good enough anymore.
Yeah, either because the market's changed, the industry's changed, or you've just gotten to a point where the classic "what got us here won't get us there," right? You just can't do it that way at the next level of, of growth, or even with the existing team or sort of the existing system. So, yeah, I mean, it's listen, for the business owners out there, if you don't have really quality CFO, obviously, if you're at the size and whatever, we have somebody in house, it's fine. Or the outsource model that Sal provides is so crucial for companies that don't need, somebody full time, but need that kind of strategic partnership, is the way I always look at it. And I know it made a huge difference in my business when we moved from having a bookkeeper and accountant to a real CFO service. It was analyzing cash flow, and we could say, hey, we're thinking about spending this money on marketing, or we're going to hire another attorney who's going to do that. Like, where are we at? Can we model it out for us? What happens in the worst case scenario? Like, do we, all that kind of stuff. So yeah, it's super crucial. You had mentioned, let me jump and we'll come back to something, but you had mentioned, I want to make sure we don't forget to cover, because I think it's interesting, which is this conversation of the AI, whether, is there a bubble, what's going on, and how does it compare to that .com experience? Because, I guess there are a couple of camps, right? There's people who may have some PTSD from the .com bubble. There are people who weren't around during the .com bubble and may not, on the flip side, take any of the lessons from it. So yeah, you raised this topic. I think it's a fun one. What is applicable and not applicable? What do you think we have with the AI?
I wrote a blog post on this. The topics that came to mind for me in that blog post, and I'll talk about here, are basically that the capital markets are fundamentally different than they were back then. Some of the main highlights are back then there was this whole category of investment banks that took very small companies public. And so the public markets, NASDAQ in particular, had a lot of small companies. And at the time they were taking companies with no or very little revenue public. That created a lot of like stock portfolio impact to individual investors who could access those investments, because the infrastructure wasn't built out in the internet yet. And there were a lot of changes and coming, and things were moving very quickly. There was almost like you were having kind of venture capital level exposure at a certain tier of the market. And once that became like very thin ice to walk on, the rest of the market was just going to respond, after that. Today, all of that risk is not really present as much in the public markets. It's much more with private asset managers like venture capital funds or different types of portfolios that you won't see. I think the thin ice that everything's standing on is not standing on top of those types of companies, at least with respect to the public markets. Because when we think about the bubble and a crash, you're always talking about the public market. So it's not that there can't be a bubble popping, but if it happens, I think it's more likely to happen inside of, private assets that, we don't see as much, where there's a lot more risk. But the big giant companies that are kind of holding up the market, or really driving the value of the market right now, if they drop 15-20% as a result of something, it's not like back in 2000 when a high flying company, I don't know, what was like one of the search engines that everybody used, like Ask Jeeves or something like that.
Yeah, I remember.
Was maybe doing like, I don't know how much revenue they were doing, but maybe they were doing like 100 or $200 million of revenue, let's just say. And then the market tanks on them.
Yeah.
That's, way different than the market tanking on Nvidia, in my view. So
Yeah, I mean, the market caps were nothing to
Yeah.
how they are now, and access to cap.
yeah, I think also the composition of the fortune of the S&P 500 was also dramatically different. In fact, I believe that out of the top 10 companies or top 20 companies from 2000, the only one that's still in the top 20 right now is Microsoft.
Right. Wow.
So,
Wow. Before I talk a little bit more about, more specifically, your business, anything, just generally that you're seeing, I mean, like, it's so interesting. I mean, I think listen, I've been doing this, I've been around a long time, you've been around a while, and I feel like it's always interesting times, right? People say, oh, there's a lot going on, right? I mean, we already talked about the dot-com, bust. You talked about this other company selling in 2008, which is great timing, right before the global, the GFC, right? There's so many ups and downs in the market. We've been through COVID. We've been through, people talk about tariffs, they talk about interest rates. They talk, it feels like it's always something, right? But there are a lot of different factors floating around now, some that people would interpret positive or negative for business growth. And my experience is there's a lot of money out there. So
yeah,
anything that you're just seeing that would be interesting in the marketplace, or trends or things that, that you're observing.
Yeah, I mean, I think that a big thing for me as far as the trend goes is, how is hiring going to change for companies with AI? And it's really related to companies having the ability to adopt certain models of applying AI in their businesses to make some practical changes.
Yeah.
But they also then have to grapple with the fact that they do need a building blocks of people where talent's being groomed and grown over time,
Yeah.
i- if they want to continue to expand their businesses. And so I think the big trend is, for me, that I look at, is how are they making decisions about entry level, early career employees, and in comparison to leveraging more kind of AI in their business, because they can't necessarily do without the trainees who are going to grow up in the business. And I think it affects more, larger knowledge based organizations like banks, insurance companies, law firms. So that's like a big one that I think about. I'm also curious about the credit markets, the private credit markets, and whether there's some issues in there. I mean, if you listen to CNBC, they from time to time have segments on, like, is the private credit market, a house of cards and all this. I do think that if some of that did unwind, it would definitely put pressure on different parts of the market, and potentially trickle down to, more Main Street types of businesses, like the kinds of clients that we have also.
Yeah.
So that one is also one that I'm kind of wondering about. I think that there's a lot of sophistication in terms of like the asset allocation models that they run in those types of businesses, but still at the same time, a lot of money has gone out, and at some point that's got to get paid back.
Yeah.
And how's that going to get refinanced?
Yeah. Love those too. So in terms of your clients and your business, I mean, you gave us some, criteria, right? Most of them are in need of some sort of capital, whether it's debt or equity. But, like in terms of industries, in terms of geography, in terms of size, tell us a little bit more about who your ideal client is, the kind of companies that you serve.
Yeah, we're mainly working with businesses that are, call it $3 to $100 million of revenue. They generally have, like, on the lower end, they may have like a bookkeeper. On the higher end, they may have an accountant or a controller level person. They could have also like a transitional situation where they've got a CFO, but they've got a bigger vision of what it's supposed to look like. And so it may be a CFO in title, but it's not really at the level of of our people. And they can't necessarily afford that on a full-time basis. And they have a lot of questions. They may have liquidity issues, they may have capital raising, they may be thinking about succession planning, selling the business in the future. We come in and basically help build out supply the financial infrastructure that they need on a very value-driven basis to get them to where they need to go. And that means that we don't really have like an industry focus. It's really a situational thing. And I have another blog that I wrote that just went out. I think it went out this week. There's nine fundamental business models. Mechanically, when you think about revenue and cash flow and what's in between that sandwich, there's only 9 real business models. So you don't need to be like industry genius to understand how carpet manufacturer is different from rug retailer store. You know what I mean? Those are 2 totally different businesses. They're selling more or less the same product, but there are different parts of the value chain, and their models are not the same.
Right.
But you don't need to know like specific things about the carpet industry or the rug retail industry to be able to be effective with them on a financial basis. So we don't really pitch anybody on industry. If we've got some industry skill sets to match, we try to bring them into the situation for sure. It's always helpful. But so it's industry agnostic. It's in that $3 to $100 million range, and it's really becoming like the trusted advisor to the owner, founder, whoever's running the business. And then as a side product to that, which is very similar but different needs, we get called in by investment banks that are prepping for sale, and they're at the company's at the stage where they want to do a transaction, but they're no different than our other clients. They just have like their pain point is not something that's keeping them up at night. It's they've got a transaction in mind, and we come in and do a bunch of work. Sometimes also we'll be brought in by a private equity fund that has already done the acquisition and they don't really like the finance operation. They may have gotten sold a much, more sophisticated version of what's actually there. And then we come in and can fix that for them. Those are projects that are like probably 3 to 6 months long, depending. The other stuff that we do with the founders directly, we basically are their team. It's just like you have us, you don't need anybody else. We just take care of it. We sort of roll with the punches. We price that on a fixed price basis, so they have a lot of predictability on what it's going to cost them.
Now, I assume the way things work with technology nowadays, you probably have clients. It's not geographically concentrated, right?
Yeah, we have clients all over. We've got some clients that are fully remote themselves. So, and our team a lot of us are in the New York City area, but I've got people all over the country. So
Good stuff. So
to find talent, it's a lot more flexible that way.
Yeah, I think that's been a big change. Like we've hired attorneys all over the country because we've been running remotely for actually since 2015.
Right.
Believe it or not.
Wow.
Yeah. It's funny, back then I didn't talk about it much, and it wasn't like I was hiding anything, but it was just that, frankly, I had split off. I had rolled into another firm and then took my team back out. And I said to the existing team, I was planning on, it was in New York. I was planning on getting my place in California. I knew I wouldn't be in the office all the time. And I said, what do you think about trying to do this remote? And they were like, yeah, so we said, we'll give it 6 months. And if it's horrible, we'll go get an office. Right. And then, it's been, 10, 11 years later. And when COVID hit, we didn't miss a beat. Like we were already full, and it's really given us this ability to hire, just hired an attorney in Maryland. We have somebody in Michigan. We'll talk to somebody in California. It really opened up the talent pool, especially, if they can work remotely. And
Same for us.
Yeah. So people want to find out more about you and the business. Where should they go?
So our website is cfoproanalytics.com. You could also find me on LinkedIn. I'm very active on LinkedIn, and It's a lot of good content there that I post, and you can check out the blog right on our website. We've got some cool tools on there. If you're doing some cap table analysis or want to compare loan options for your business, there's some quick calculators there that you can use. And we also have a CFO assessment tool on there where you can kind of go in and just follow some questions in a question form, and it'll give you a sense of like, where do you stand in terms of your needs? So there's some cool stuff on there to play around with.
Sounds great. Sal, my final question on the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world for people from oppression to why I've been an entrepreneur for decades and haven't had a boss. What does freedom mean to you, and how does it impact your life and business?
Yeah, freedom for me is, really having the time to, do things that I enjoy, which are, spending time with my family. I'm going to take a trip out to London. Both of my sons are out in London right now.
Right.
I think about also just the opportunity that the economy in general can give people, young adults. I think about young adults a lot these days because of AI and because of the ages of my kids and how the world is going to change so dramatically for them.
Sure.
And, having them have the freedom to make some choices to have like good careers and families and whatever else it is that they want to do that makes them happy. And it doesn't just apply, when I think about it with respect to my own family, but also just the population in general. So those are the kinds of things I think about.
Love that. Salvatore Tirabassi, thanks for being such a great guest on the DealQuest podcast.
I appreciate your time, Corey. Thanks for having me on.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. If you are interested in finding out more about my law firm, the services we provide to entrepreneurial and growing companies across industries all over the country, and my partner Brian Megan and I, and my amazing team, just head over to kupferlaw.com. That's kupferlaw.com. And if you want to follow more of my content, head over to my LinkedIn page where I post regularly. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.